Have you ever wondered what might trigger an IRS audit? Imagine, if you will, opening your mailbox to find that dreaded letter from the IRS. Your heart races, your palms sweat, and suddenly your whole financial world feels like it's about to crumble. But what if I told you there are ways to significantly reduce your chances of ever receiving that letter or even getting audited in the first place? Well, today I'm going to explore not just how to avoid an audit, but also what to do if you find yourself face-to-face with an IRS agent. Today we're diving into the 8 most common reasons the IRS might put your tax return under the microscope. Stay tuned to learn how to avoid these red flags and protect yourself from the stress of an audit. And I'll tell you, I've been through them with clients, and they do get stressful. Before we jump into today's episode, let's take a quick look back at yesterday's show. Yesterday we talked about how to set up your infant, yes, you heard me right, on the path to great credit. It was a great show. If you miss it, you can check it out at askralph.com. And the takeaway from yesterday is it's never too early to start building a strong foundation for your child's future, and that starts with a strong financial foundation. Well, let's start today's show with a message from Amy. Amy writes this: "Dear Ralph, I've been self-employed for the past 3 years, and I am terrified of being audited by the IRS. I've heard horror stories about small business owners facing hefty fines and even jail time. It seems like I'm hearing stories every day about these 80,000 new IRS agents and how they're coming after us small business owners. Can you please shed some light on what might trigger an audit and how can I protect myself? I'm trying to run my business honestly, but I'm worried I might make an innocent mistake that could cost me everything." Well, Amy, let me start by thanking you for your question. That is a concern that many of my small business clients share, and I am super happy that you reached out. Today, I'm going to address your concerns, and I'm going to give you some practical strategies to keep your tax return above board and avoid that IRS audit. And before we get started, remember, the whole point of Ask Ralph is to answer your questions. So I want you to keep them coming, just like Amy's question today. You can send your questions to ralph@askralph.com. Or if you'd rather, you can go right to our website. That's askralph.com. There's a microphone icon at the bottom. You can click on that and just record. Tell me what's on your mind, and I'll put your answer on the show. Well, I'm thrilled you joined me today. Your trust in the show means the world to me. And truthfully, I am committed to providing you the best knowledge and insights you need to master your finances while growing in your faith. If you're finding value in the show, I'm going to encourage you to visit our website. I mentioned that a moment ago. That's at askralph.com. I would really appreciate you joining our community and sharing the show with others who could benefit from it. If you know somebody that's going through an audit or dealing with IRS issues, this is a great thing to do. And remember, when you join our email list, you'll receive a free copy of my book. This is it right here, Mastering Your Finances. Now, if you went out to Amazon to buy that, it would cost you $10, but it's my gift to you for being a part of our community. So why don't you join today? Let's start by reflecting on a powerful verse from the Bible. This one comes from the book of Proverbs, chapter 11, verse 1, and it says this: "The Lord detests dishonest scales, but accurate weights find favor with him." Well, that's a really good verse for what we're going to talk about today. It reminds us the importance of honesty and the importance of accuracy in all of our dealings, especially when it comes to our finances and taxes. It's not just about following the law, but it's also about living with integrity in a way that pleases God. Well, now, without further ado, let's address the burning question. Ralph, what are the 8 common reasons for getting audited by the IRS? And I'm going to tell you to buckle up because I'm about to take you on a journey through each of these reasons. I'm going to come tell you some real life stories that'll help you understand the risk and, more importantly, how to avoid them. Well, let's start with number 1. And that's a big one. That's unreported income. Just picture this. It's a warm summer evening. Friend Tom is sitting on his porch. He's sipping lemonade. He's feeling pretty good about life. He just finished doing his taxes. He's confident that he's done everything accurately. But little did he know a storm was brewing. You might ask, why? Well, here's why. Tom had done some freelance work that year. He earned a few $1,000s on the side, what we call those side hustles. But when he was doing his taxes, he thought, Ralph, it's just too small to report. And he left it off his tax return. Turns out that was a big mistake. A few months later, Tom received that dreaded letter from the IRS. What the IRS had done is he had matched his return against those 1099 forms that his clients had sent to them. And guess what? The numbers didn't add up. What he had put on his tax return didn't match what was reported under his Social Security number. So guess what? Tom was facing an audit. Not only was he facing an audit, he was facing potential fines and penalties. and back taxes, and bigger than that, a whole lot of stress. So what's the lesson here? Number one, you've got to do this. Report all your income, no matter how small that is. The truth is, the IRS has sophisticated systems to cross-reference your income, like we talked about. They're going to look at what you report on your tax return, and they're going to look at what was reported under your Social Security number. And that information could come from employers, it could come from banks, all kinds of other sources, any freelance work you did. And the truth is, the thing you need to understand, even a small discrepancy is going to raise that IRS red flag. Well, let's move on to the second one, and that's home office deductions. Now, I did a show about a week ago on this. I'll put a link to that show in the show notes if you missed it. But let me tell you about my client, Maria. She's a graphic designer who worked from home, and she was thrilled when she learned about this home office deduction. She did the right thing. She measured her entire living room where she occasionally worked. Now, I'm going to remember that, occasionally worked, and claimed it as a home office deduction. Well, fast forward a year, actually the following summer, and if you understand how audits work, it's usually about a year later, Maria is celebrating a big win. She had just gotten a new client, the doorbell rings, and all of a sudden, to her shock, guess what's standing at her front door? It's an IRS agent. Well, what triggered this? Well, there was an unusually large home office deduction that had triggered an audit. So I wouldn't have advised her to do this, but she asked the IRS agent to come right in and walk through her home. In a few minutes, Maria realized that was a mistake. Because in truth, her office was also where she watched TV. She entertained guests there and even slept on the couch sometimes. And the IRS agent explained to her that a home office must be, and I used this word earlier, intentionally. It must be used exclusively for business to qualify for deduction. But what happened to Maria? Well, Maria ended up owing back taxes, she owed penalties, and they even charged her interest. So Maria learned in a very hard way when it comes to home office deductions, you've got to be honest and accurate. And as an aside, never let the IRS in your house. Go hire a tax professional, go hire an enroll agent or somebody like me or an attorney, and don't let them into your house unless you absolutely have to. Well, let's move on to number 3, and that's excessive business expenses. Let's talk about my client, John. Now, John was a real estate agent, a successful one at that, and he had a penchant for the finer things in life. He had a core belief that to make money, you had to look the part. So John bought designer suits, he drove a luxury car, he dined at the high-end restaurants, all while claiming these as business expenses. You know, he was putting them all on his tax return. Well, guess what? John's lavish lifestyle caught up with him when the IRS flagged his return for audit. What did the IRS do? They combed through his receipts, and it became clear to them that many of his expenses that he called business actually personal. Well, what was the result? As you could have guessed, John faced a hefty tax bill. They nailed him with penalty and interest. And he learned while some business expenses are legitimate, they gotta be ordinary and necessary for them to work. That Rolex that he put on his tax return just wasn't a justifiable business expense. It's not gonna work. So that was the big lesson here. They gotta be ordinary and necessary. Well, let's move on to the next thing, and that's number 4, and that's what we call cash-heavy businesses. So let's meet my client, Lisa. She owns a small bakery. Her pastries were a hit. Everybody loved them. Her business was booming. But the problem was, Lisa would pocket some of the cash she got. You know, somebody come in and buy a Danish or a coffee, and that money just didn't get to the register. It ended up in her pocket, which means they weren't recorded either. So one day, just like my other client, an IRS agent showed up at her bakery. They had done some homework before they got there, and they noticed her lifestyle didn't match her reported income. Look, they looked at her tax returns, and they saw that she wasn't reporting a whole lot of income. They dug in deep, and they found discrepancies. And now, listen, here's the thing. What Lisa did that was an absolute disaster. Not only was Lisa not recording those deposits, she wasn't reporting those sales, she was taking that cash and putting it in the bank. So the IRS pulled her bank statements, unbeknownst to her, went to the bank and got a subpoena for them, added up all her deposits and said, wait a minute, on your tax return, you only reported, let's just say $200,000 in sales, but you deposited $300,000 in money in the bank. How does that work? It's a huge red flag. And Lisa ended up facing some serious consequences. They nailed her with substantial fines. And to be truthful, I'm surprised they didn't, but they talked about criminal charges for tax evasion. So what's the takeaway with this? Listen, if you run a cash-heavy business, you've got to keep meticulous records and report all your income. The truth is, the IRS has ways of estimating what your income should be based on similar businesses. They have the data and they're going to use it. I had an example of this in my own practice. Again, there was a pizza shop down at the beach. This pizza shop, unbeknownst to me, wasn't telling me that they had cash sales. And guess what? The IRS got their 1099-K form. If you don't know what that is, at the end of the year, anytime you have a credit card, a processing company, there's a 1099-K that's reported that shows all those credit card charges. Well, the IRS got that report as they're supposed to, and they compared it to what was reported on the client's tax return. Well, guess what? What was reported on that 1099-K for credit card sales was exactly what was reported on the 1099-K. So there was no notice of, hey, did you ever get any money in that was paid for cash? And when somebody come in and paid cash for a pizza? Well, they visited my client. The IRS did. And I think, in fact, this one was a state audit, actually, now that I think about it. The state auditor went out there and visited them. They said, hey, I'm going to buy a pizza. And they gave him $20 and said, hey, you pay for it with cash. And then the auditor was pretty slick, said to the client, said, hey, do you report those? And the client said, oh, you know what? Actually, what we do is we use that cash to pay out, for the bread guy and this and that. And he was stone cold busted. So if you've got a heavy cash operation, you've got to make sure you're reporting that cash. Let's move on to number 5, and that's claiming hobby losses. So let's talk about my client, Bob. Now, Bob was an avid photographer, and he decided, hey, I really like doing this photography work, and he turned his passion into a business. And every year, Bob would buy the newest cameras, he'd buy the coolest stuff, he had the best software, and every year he claimed a loss on his photography business. Now, at the same time, it's a funny thing, he was continuing to work as a full-time accountant. Well, the IRS saw this, and they saw his what they call perpetual losses. And again, they decided to dig in a little deeper. They audited him. They discovered that Bob rarely did any marketing. They looked and said, are there any advertisements? They looked at social media. They also asked Bob if he had a business plan. And then when they asked him about his customers, Bob said, oh, I deal mostly with friends and family, and I do it for free. That was the wrong answer, because the IRS determined that Bob's photography business was a hobby. It wasn't a business. And guess what? If it's a hobby, you can't take the losses. They disallowed all his losses. And Bob had to pay back taxes. He had to figure out a way to pay back those penalties and interest. So remember this. This is the takeaway from this. If you have an activity, you've got to run it like a business. There has to be what they call a for-profit motive. And if you're continuing to have losses year after year after year, you're going to get audited. So that's another big red flag. Let's move on to number 6. And that's what I call large charitable donations. Let me tell you about Amy and Mike. They were clients of mine as well. They're a generous couple, and they love supporting their local church, and they did a lot of things for various animal shelters and all that. And at one point, they decided they had this old car. I mean, this thing was beat. And they decided, well, we're going to donate this old car. Now, they thought, you know what? If we went to sell this, we might be able to get about $4,000 or $5,000. But hey, you know what? We can just say it's worth $10,000. And that's what they put on their tax return. Now, they had done their own tax return at the time. They came in to see me later, and they put it on there. They thought that's what it was worth. They hadn't gotten appraisal, but they didn't realize that this large donation relative to their income was going to catch the IRS's attention. The red flags went off, so they got audited. The IRS did their homework, and they found out that the actual fair market value of that car was $3,000. So it wasn't worth $10,000. So they had overstated this charitable contribution by $7,000. Well, what happened? Well, Amy and Mike had to pay back taxes. They paid penalty and interest. So what's the lesson here? It's you've got to get proper documentation for your charitable contributions, especially those non-cash items. If something is valuable, the best advice I can give you, and this is within the IRS code, if it's worth more than $5,000, you've got to get a professional appraisal by somebody who is recognized by the IRS as being a professional appraiser. So again, watch out for that one. Big red flag. Let's move on to number 7, and that's rental property losses. Let's talk about my client, Emma. Emma was doing well in life. She bought a beach house. She thought this would be a great investment property. And what she did was she rented it out occasionally. But the truth is, when I talked to Emma, she used it mostly for family vacations. But when she did her taxes, again, this is somebody who did her taxes before she came to me, and she would claim these losses on her rental property because, frankly, she wasn't getting much income in, but she had the interest that she was paying, the property taxes, the maintenance fees, the HOAs, all those things. And she was showing these significant losses. Well, the IRS, again, red flag goes up. They audited her return. And what they found was that this rental property was mostly used for personal use. What the IRS code allows is you can use it personally for 14 days or 10% of the rental days, whichever is greater. And what ended up happening is Emma couldn't claim her rental losses. And that was huge because she had done this year after year. So she had to go back and pay back taxes for several years. They charged her interest, they charged her penalties, what they call the error penalty or whatever you want to call it. They went after her. So what's the moral here? The truth is, rental properties are complex. You've got to understand them before claiming those deductions. That's an area where you need to enlist the services of a tax pro like me. And let's look at number 8. That's the final one. And this one cracks me up every time I think about it, and it's round numbers. So let me tell you, and this wasn't a client of mine. This is one I read about from another colleague of mine on Facebook, and this guy's name was David. Now, he was a small business owner, and like most small business owners, he was always rushing around to get everything done, and it came time to do his taxes. And David said, you know what? I don't have time to go add up all those receipts. I don't have time to add all those things. So he just estimated, and he rounded them to the nearest $100. So he had, for example, office supplies, $500, travel expenses, $1,000, marketing, $1,500, and so on and so forth. Well, the IRS, again, they looked at his return. They thought it was really suspicious that everything was a round number. So what did they do? They audited him. And here's the problem. The first thing they said to David is, okay, we got your return, but we want you to provide exact documentation for each of those expenses. We want to see the receipts. Well, guess what? David didn't have them. And when he actually went back and added up his receipts, his numbers were way off. So what's the takeaway? You've got to keep accurate records. You've got to report the exact amounts. I've had clients come into me and they say, Ralph, I have this one particular real estate client. And every year, and I'm not going to say he or she because I don't want to give it away, but they will come in every year and they say, okay, what did you pay for marketing? Let's put $1,500. Oh, what did you pay for this? Oh, let's put $1,200. It doesn't work. You got to not do that because the IRS wants you to have accurate records. They want you to report the exact amounts. If not, it's a big red flag. So now we've covered these common audit triggers. Let's talk about some strategies to avoid an audit. And the first one is this. Number 1, be honest and accurate. You can take legitimate deductions. The second thing, keep detailed records. You need to save those receipts, those bank statements, and all that documentation. Double check your math. This is a no-brainer. Simple math errors can trigger an audit. Be consistent. If you are doing one thing in one year, do the same in the next, and so on and so forth, because the IRS will look at any fluctuations or changes. A big one, use tax preparation software or consult with a tax professional like me. We can help you avoid those mistakes. If you've got a complex tax situation, you might even think about attaching an explanation to the return. Another big one a lot of people don't think about is file on time, because the truth is statistics show that late returns are more likely to be scrutinized. And here, the last one I want to put on the list of things you've got to do. If you receive a notice from the IRS, respond promptly and respond thoroughly. And I'm going to say, hire somebody to help you, because this is the truth. An audit doesn't always mean you've done something wrong. Sometimes the IRS just needs clarification or some additional information. But those audit things can be stressful. They're time consuming, and you want to avoid it if it's all possible. Well, let me do a quick recap. We talked about those 8 most common reasons for an IRS audit. We talked about how to avoid them. The big ones we talked about was unreported income, rounding numbers. All these triggered red flags. So I reinforced, look at honesty, be accurate, have good record keeping. These are really your best defenses in an audit. So tomorrow's show, we're going to talk about 7 money mistakes made by those over 50. So if you're 50 or getting closer, maybe you're a little bit past that, like I'll be 52 in a week or so, it's going to be a great show to talk about how to approach those golden years. If you're feeling overwhelmed, if you've been audited, or you're worried about getting audited, your records are a mess, if you got those tax concerns or maybe some financial matters, I can help you. The best way for me to help you is to schedule an appointment with me. You can go to askralphpodcast.com/store. I'm going to charge you $150 for a consultation, and I'm going to work with you to improve your finances. Maybe I'm going to help you with your business finances. Maybe we're going to talk about growing your business. I am going to, at the end of the day, my goal is to help you achieve all of your financial goals. We can work together to create a personalized plan that's going to put you on a path to financial success, but more importantly, peace of mind. Remember this. My passion is to help you achieve financial success. I want you to live out your dreams. I want you to grow in your faith. And I know together we can master your finances from a Christian perspective. So as I always end the show, I want to tell you this. Stay financially savvy and God bless you.
Thank you for joining us on the Ask Ralph podcast. And with a simple click to subscribe, we'll invite you back to our next episode. And remember, financial issues don't have to be complicated. Just ask Ralph. The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media, Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.